Good afternoon, ladies and gentlemen, and welcome to the PCI Pal update on the recent fundraising. To start with, if we could cover a couple of housekeeping items. Before we begin, we would like to submit the following poll, which you will see on your screens. Throughout this presentation, investors will be in listen-only mode. However, questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen, or if anyone has dialed in via PCIPAL@walbrookpr.com. We will endeavour to answer all questions today. However, failing that, we will review all questions submitted and publish responses where appropriate. These will be available via your Investor Meet Company dashboard. Finally, I'd like to remind you that this presentation is being recorded. I would like to now hand you over to Chief Executive James Barham and Chief Financial Officer William Good. James.
Excellent. Thanks, Tom. I suppose welcome back, everyone. Thank you for following us on IMC. We were just talking about how many followers we have on here now. So it's fantastic to see that, because we are, putting in the effort to reach out to our private investor base. Thanks for taking the time today. We do appreciate it. This update is going to give you a little flavour for the recent fundraise that we just ran. It's a shorter presentation than we've been used to on here. So what I will say is, if you're new to our story, please do visit our website, the investors pages, or dig into the Investor Meet Company portal, where you can watch some of our previous presentations, which have, we have more time on those and we spend more on the background and the strategy. Also, our knowledge centre on our website is great if you're just looking for more market information around our fairly specialist space, and you want to get a look at what we're doing, more generally on a sort of day-to-day tactical basis as well. So we will keep some time at the end for questions and answers too. Hopefully we'll have plenty of time for that, but any that we don't get to will also update to the portal. So this is all about the fundraise, this presentation. Why now for the fundraise? Why was the timing that it was? It may not have come as a surprise to some of you, and certainly we'd had fairly consistent feedback from our half-year roadshow just a month or two before the fundraise that there was quite a bit of support for pushing a bit harder from our investors. And as I stated in our last annual report, we're 4 years into the current 5-year plan that we set out since we really started on this journey with PCI Pal. And I've been working, not just myself, with William this year on a refreshed version of that 5-year plan as well. And as part of that, naturally, we're looking out further in the next 1-2 years, which is what you've been able to see in the market forecasts that are out there. And we're looking out to see how we can keep these rates of growth going with the same strength that we've shown in the last few reporting periods. And revenue today is growing strongly. Our revenue growth rates at the half year exceeded 50% year on year. We're forecast to break 60% at the full year. The forecasts are already showing similar sorts of rates of growth for revenue next year, certainly 40% plus. And actually, we were getting very close, and certainly within shooting distance of the first months of sustained cash generation and profit. So to get to that point, and to be achieving these things, we've come a long way since we started on this journey over 4 years ago now. But as a SaaS business with a global opportunity, we're looking to really sustain those strong rates of revenue growth when we're looking out 3, 4, 5 years plus onwards. And this is really, and what this comes down to ultimately is how we deliver value back to our shareholders. And we see us, and the best opportunity that we have to do that through the appreciation of our stock, with the value of the company going up. So that's why we've done what we've done. And in terms of the timing right now, as we know from our revenue model and how IFRS 15 impacts our ability to recognize revenue, new sales bookings take some time to feed through into revenue as well. So acting right now ensures we're driving hard at those years further down the line to continue on this similar growth trajectory. But we're doing it from a much more stable base than when we first raised money, which, frankly, for this team is hugely exciting to be able to do it from this very different position of strength that we have today. So more on that in a moment, but before I get into that detail, we'll give a bit more background and an element of the strategy as well, so that we're completely devoid of that. And then we also have an update since the half year. It's the usual disclaimer. Now, in terms of what we're all about, our mission at PCI Pal is to provide organisations anywhere in the world with secure payment solutions for business communications. So by this, we mean companies taking payments by credit and debit card, primarily across voice or phone, as it's known, chat, social, email, messaging, any kind of communications that goes into what's commonly seen within the contact center mix, or as it was known, the call center mix, or business communications as we call it today. And not only do we allow our customers to secure this data when they're handling payments across these channels, but importantly, we allow them to also comply with the latest data security governance and regulation that's out there. And in particular, the area we're particularly interested in is PCI compliance, but it does have a positive impact on broader regulation like GDPR, for instance. Now, as a business, we're a true SaaS company, which means that whilst we're small, we can deliver our services anywhere in the world, and we can do that very cost effectively as well. And although we do talk about being global and serving customers across the world, very much our focus to date has been on the UK and the US. We are currently in our third full financial year in the US right now, so the UK business is slightly more mature, but hence the fundraise and looking to expand on these focus areas. Now, in terms of what we do, and as I say, this is sort of simplified, so if you do need more information on this, please do look back at some of our previous presentations. But we're pretty simple on this front. So 3 core products. We're purposely what we call a pure play in what we do, because we primarily sell through partners, and in particular that's resellers, many of which we're quite tightly integrated to. So we're very careful not to tread on the toes of those organizations that we work with. We're there to solve a very specific issue and to do it across all their communications channels, and we make that messaging very clear to them to help us with that channel approach, which I'm going to talk a little bit more about in a moment. The 3 core products that we have do cover the entire spectrum of business communications payments that occur. A term being used today is this sort of term for conversational commerce. And we are able to cover that with the 3 core solutions that we have. Now, the main one of those is Agent Assist, which is the first one there you see on the left, which is secure payments for live agents. So this is a person who works in a contact center handling phone calls. So a live agent interacting with a customer by phone typically. And we sell this service more than any other. And then we have digital, which we launched in January just last year, and is growing quickly for us. Which is really an extension to Agent Assist, and it enables secure payments through any number of digital channels as well. This is really catering for the fact that contact centers really handle the full omni-channel mix now. So a single agent sitting in a contact center doesn't just answer phone calls, they deal with interactions through web chat, through chatbots, through Twitter, through WhatsApp, however that organization is communicating with their customers. So then we have a solution that covers the full omni-channel mix. And then you have IVR as well, which is automated phone payments. So effectively, this is an auto attendant where there's no agent involved. So it's press 1, press 2, these types of services. But we also have speech enabled as well for IVR, and also Agent Assist. So we've got a bunch of features that tie into these core products as well. And there's plenty more detail on that on our website. Now, as I've mentioned, we sell these products primarily through a channel sales model, which means we have resellers primarily and other partners through whom we obtain business. So I have a slide on this in a moment, but we've got the most mature partner offering in our space. We committed to it very early in our market, and we've continued to commit to it long term. As an example, and some of these companies are shown on that slide there, we're resold by over 50% of the Gartner Magic Quadrant for the CCaaS market in Western Europe and North America. So CCaaS is the term for contact center as a service, effectively cloud contact center telephony. So it's a very buoyant, fast-growing market, and we've got a very strong presence there, which has been very successful to us so far, and is growing. And the partner base in general continues to expand. We're very targeted about the organizations that we want to work with. And it's fair to say, actually, that most of these relationships have a lot more potential in them. Most of our partners are large organizations, a lot larger than us, certainly. And it does take time to, engage with these organizations and get them moving. Sometimes signing the reseller agreement is the easy part. It's actually engaging them, enabling them through sales, marketing, product, and then full education piece to have them actually selling our services out to their customer base is the tricky part. In terms of the technology, so we are a cloud provider, as I've said, so we are a SaaS provider. This is a real differentiator for us in the market. We were the first to launch a true cloud solution available globally in our space, some way ahead of other organizations in our market, and we retain that position at the very front of our space in cloud today. To a degree, we had a first mover advantage, I suppose, and that's one of the key reasons we've been particularly successful with what we call our integrated resellers. So these are the cloud vendors in the CCaaS, UCaaS space that I was just referring to. So the likes of Vonage, 8x8, TalkDesk, who are primarily cloud organizations who do not want to work with hardware environments. So typically they'll work cloud to cloud with any vendors that they choose to partner with. And we very much focused our product development efforts in the early days on our ease of integration with these partners, and particularly the cloud to cloud light touch capabilities that we have. And we're very strong there from a partner perspective. Now, cloud's also the reason why we have the ability to service the breadth of the contact center market. So I've talked extensively in our last update 2 months ago on one of these IMZ presentations about the market opportunity in contact centers in the UK and the US. And the vast majority of the market size is less than 250 seats. So they're small to mid-sized contact centers. So cloud gives us the ability to service those sorts of size organizations cost effectively and to be able to do it at scale over time. So we have a lot of large customers too. So we have some of the largest contact centers in the UK and the US. The largest we have is certainly more than 5,000 seats in the UK, but actually we see the long-term scale opportunity being the small to mid-size end of the market, and cloud really enables us to fulfill that. Now, when we set out at the beginning of this journey with PCI Pal, we set out to build a channel sales business, selling primarily, as I've said, through reseller partners. I often say to our investors that channel selling is a big commitment for an organization to make. It's easy for anyone to get a reseller agreement signed. It's the work that goes in after that that is the key to making the business successful with a channel sales model. And we've really invested in that and committed it to that in terms of, in particularly in our sales and marketing side of our business, where we have hired people specifically for their experience in channel. And that's become a real differentiator for us in our market. We typically see between 70 and 85% of our contracts coming through channel partners. That's a range because it will vary from time to time. At the half year, we were at 74%. So that's broadly where I'd anticipate seeing it. And that means there's still a quarter of our contracts that will come through direct, which is why we use the term partner first or channel first. And that's because we sell direct business too. And we retain the capabilities to be able to sell direct through sales and marketing structures that we have in place. The direct business that we do tends to be larger strategic deals, but we will also try to fulfill any direct business through partners if we get an opportunity to do so. We split our partners into 4 groups. Now, I'll focus mainly on the top 2 there, which are integrated partners and solution providers. These are our reseller categories. So the integrated partners, as you can imagine, are where we've actually integrated to those partners' environments. And as I say earlier, typically they're cloud vendors, so the likes of the CCaaS and UCaaS vendors, where we have quite a repeatable integration model with them. So we'll integrate with them once, and then they can sell our services through that integration numerous times to their customers. And we'll typically integrate with their platforms globally if they are international organizations as well. That's actually one of the reasons why we have customers dotted all over the place. Even though our focus has been very much UK and US, we do get pulled into other regions, whether that be mainland Europe, Canada, or Australia. And that's where we're seeing scale coming through as the integrated partners. And then you have solution providers who are also, very valuable resellers to us. They tend to be less numerous in the amount of deals that come through, but the sales themselves can be slightly larger, a bit lumpier. They're not custom as such, but they may have more custom elements to them. We have a number of very strong solution provider partners in the UK, particularly where our relationships are a little bit more mature with local partners because we've been here longer. So the likes of Civica and Capita, we've been very successful in. We're very strong in public sector in the UK. We have more than 50 local authorities using our services, as well as two of the largest central government agencies as well. Other solution providers of interest, payment providers, there's a number that we work with, including the likes of WorldPay and Barclaycard. And then an interesting area for us is BPOs. So these are your large contact center outsourcers. So some of these organizations many of them have tens of thousands of agents. Some of them might have hundreds of thousands of agents across the globe. So you can see why they're interesting partners for us. And we did report the half year that we've been quite successful in our targeted strategy to expand our relationships there, in particular with one or two major global US headquartered BPOs. The final two categories there are more introducer partners, so that introduce us to business that we then sell direct. And these sometimes can be where we start out a partner relationship and then we'll look to progress it to a reseller arrangement. But reseller arrangements aren't always possible, and these two sectors cater for those scenarios. Okay, so I think it's important at this point to just take stock of where we've got to 4 years into this 5-year plan. It's important for the reasoning for the recent fundraise. We've established a subscription-based SaaS recurring revenue model and a business with very high customer retention and very low churn. So it's very sticky SaaS business, as you might say. Having launched in the UK effectively as an incubated startup that came out of the previous organization we were created in 2016. We then just 2 years later successfully launched our business into the US off the back of our first fundraise. Now that's going very well for us, but no doubt when we did that fundraise and we told investors that we were planning to launch in the US, that was seen as quite risky at the time, given our size and our stage. But I think that's worked out very well for us to date. And really across that time, as I said, we've established a market-leading channel sales business, which leverages this fantastic cloud platform that we've built, and we have customers live across the globe on. So both of those things combined open up real opportunities for this business to grow further. But as I've said, whilst we talk about global, we very much have a focus and have done today for the UK and US, which is where all of our people resources are based today. So I'm going to hand over to William, who is going to give a bit of a reminder of the half year and then an update on our Q3.
Good afternoon, everyone. Yes, so as a finance director, we have a set of key metrics that we want to follow, not only mapping out the year but into the future, driven by standard SaaS-based metrics. So you want to have a business with strong revenue growth, high gross margin, low churn, high contract wins, high recurring revenue, etc., etc. And we map these metrics out. And if you look at the half year to December 20, we achieved a green headlights on all of those traffic lights for that period. So revenue grew by 56% year on year to 3.19 million. 86% of it was pure recurring revenue. Gross margins continue to improve from 67 to 73%, and they will continue to improve into the future. The reason why we do have a cost of sales, is we do have a first generation platform, which we still use. It still generates about £1.8 million worth of revenue, but it's a revenue share model. So we pay 50% of that out to our telco partner. Whereas the new AWS platform is all ours. We own the IP outright, and some of the deals are 100% gross margin, and others where we do need to sometimes connect to the older type contact centers who still have PSTN type setups rather than cloud or VoIP setups. We do have a small cost of sales as we put telephony lines into there. But overall, we're expecting the margin to continue to grow as the Amazon platform grows, to reach 85-90% overall over the coming years. TACV is a core number for us. That continues to grow strongly. As a reminder, TACV is the stack of all the contracts we have signed at any one particular time, whether they're actually installed or not within the business. So, for instance, if we had signed a contract on the 31st of December for £100,000, we would have added that to our TACV number. However, because of the nature of our business and the accounting rules under IFRS 15, we're unlikely to start recognizing revenue on that contract for a 4-month, 5-month period while we go through the deployment, because we're only allowed to start taking revenue once the contract has been materially delivered. However, I'm pleased to say that TACV continues to grow, continues to give us high revenue visibility of the next year's revenue. So this figure covers a lot of what we're seeing in FY22. And why is it growing? Well, we've continued to sign new annual contracts or new contracts. So we signed £1.68 million worth. That was 100 clients, so an average annual contract value of £16,000 each. And that was a good, strong performance on the period. More importantly, we have been a loss-making company. We are edging towards cash break-even. The sustained cash break-even forecast was before this expansion was set at the end of this calendar year. However, at the end of December, we had cash of 4.23 million, and if you excluded our borrowings, we still had net cash of 2.11 million. So that in the 6-month period, we'd spent £900,000 worth of cash, in spite of reporting losses of £1.8 million. Why is that? Well, our business model allows us to charge annual licenses up front where we can, and we were very successful in doing that. Now, during the fundraise, we updated the market on the performance to the end of Q3, and I'm very pleased to say that the strong growth and strong performance has continued. So we've added another 51 new customers in the 3-month period, and those equated to another £830,000 worth of ACV, annual contract value, which is the recurring revenue element of it. So again, roughly £16,000 per contract. That allowed us to push our TACV up further to 8.9 million, which is a 33% increase on from the end of June 2020. TTGL, one of our core metrics, for those who know us well, remains in line with the management expectations. If you remember, it takes us around 4 months from signature to deploying a contract. That's an average. Some are quicker, some are slower, but that's the average, and that remains in line with our expectations. More importantly, cash continued to increase. So as at the end of March, we had £5 million in cash in the business, so it's up £750,000. But more important, net cash had improved by £1 million because I've been paying down some debt. So if you actually compared the 3.16 million net cash figure you have there to the end of June, we've actually generated cash in the first 9 months of the period, 9 months of trading, which was ahead of expectations. Just one word of warning, though. The strong cash is from not only our strong sales performance, but also renewals of existing contracts. And we do have a number of larger contracts, our larger clients renewing around the Christmas period, which we then collect in this Q3. So I'm expecting in Q4 we will have a cash outflow. and the beginning of Q1. But we were still on target to hit our sustainable cash break even as at the end of this calendar year. However, as James would explain in a minute, with the expansion, we are expected to push that out a little bit. And I've seen there's a question already come in on that, so I'll answer that one later on. I'll just hand you over to James now.
Thanks, William. Okay, so yeah, onto that fundraise. So we've built a strong foundation, having established our UK and US businesses, which I think, longer term, we see those being more the sort of cash cows for the organisation, given the size of the contact centre markets in those two countries. But we've built a strong base there now. We have a highly scalable cloud technology environment. It's proven. It's handling customers across the globe for us. High amounts of transactions going through that platform. And that platform continues to give us the opportunity for real operational gearing when it's paired up with our channel sales model as well. And then finally as well, additionally, we know that the opportunity that we have is a global one. Our value proposition is global. PCI compliance, the problem that we solve, is a global requirement. So this is a different foundation from which we're pushing on this time round. And this is a true step forward using growth capital through this fundraise. So it's a very different place for us to be to where we were previously. So we have now raised, as you're aware, £5.5 million to fund further expansion into new territories of mainland Europe, Canada, and Australia. So by doing this, we believe we're going to be growing our addressable market by more than 40%. So that's a substantial increase in growth of the addressable market. We've specifically chosen territories or countries with strong contact center markets and I suppose business cultural, business operational similarities to the UK and the US. They're markets that we know reasonably well already. We have availability of our services in those territories already, servicing existing customers. So we already have instances of our platform in Dublin, Frankfurt, Montreal, Sydney, as well as what we already have in the UK and the US. So we don't have to do that new. One of the reasons that we do have customers in these territories already is because, as I've said earlier, we have global partners. So we've had partners pulling us in these directions. And actually, as a result, in all three of those regions, in fact, numerous countries across Europe, whilst we don't have huge amounts of customers compared to the UK and the US, we do have referenceable customers. And we know from going into the US completely cold how important it is to have referenceable customers. So we've got some great names that we can use in those regions. So, for example, Queensland State Government in Australia is a reference customer of ours and has been live for well over a year to 18 months, and that carries a lot of value, particularly when a lot of the sales we're making are pretty greenfield. So it's the first time these organisations have procured these types of services. But to date, we've been very opportunistic, really. So this fundraise means we can be proactive into these territories. We can be more complete with our expansion plans. We can do it properly, and it will really allow us to stamp our ownership on this market that we're in globally, and that's been our vision since pretty much day one. And we do look at this, from a global perspective. Now, in terms of how we're going to be investing the funds and the use of proceeds, there's three key areas really across sales and marketing, customer success, and engineering and product. By majority, it's into sales and marketing, and that's because we have the cloud technology. That means that actually the backbone is there, so we're really just layering on sales and marketing activity as needed, and we'll very much be using the strategies in sales and marketing that we've deployed successfully in the UK and the US. I mean, it's not been perfect since day one, but we've learned a lot in that time. So, we don't see we need to change it considerably, although clearly we're going to be adapting it for local considerations, and obviously languages is a consideration as well. But we're well on the road to what we need to do there. And then additionally, to continue to achieve low churn and driving ideally positive net retention, which is what we achieve today, ever so slightly above 100% net retention. We're going to be strengthening our customer success functions across, in the first instance, North America and EMEA. So, churn and retention are key metrics for a SaaS business. They're metrics that we're going to start talking to investors a bit more about as well. So we intend to hopefully start doing that from the beginning of the next financial year. So you can use those in your assessments of us and how we're performing. While we're adding ACV, as William's just described, the sales going in the top, we need to make sure we're not losing out the bottom. So we need to make sure that we can sustain the sorts of rates we've got today. So we're going to be investing there. And then, finally, we will, to a lesser degree, in terms of the amount of investment, but we will continue to strengthen our product and engineering capabilities to ensure that we are the best option for our partners and our customers, and that we evolve our product set over time to meet demand. We really want to be on our toes in this respect. So it's not just we certainly don't want to be reactionary. We want to spot trends before they become reality, particularly from a product perspective. So all in all, the main spend is people related in those areas, plus some marketing. We're looking at around 25 to 30 people over the next 2 years, making up that additional spend. And as a result of that additional investment, as William's just said, and as shown in FinCap's latest research note, we'll be pushing out our first months of break even from the back end of this calendar year by about 12 to 18 months. But this will further fuel the long-term rates of revenue growth that I've been talking about as we've been going through this presentation. So just to round up before we get to questions, we feel like we've got fantastic momentum with this business, and we want to keep that going. We could have sat it out and worked towards our first months of profit within the next 6 months. We can clearly see how we get to that point. And as you can see, the cash burn has really dropped off. In fact, we've generated cash in the last quarter, as William's just said. But in terms of delivering value for our shareholders, which is what we're here to do, when we look out over the next 3, 4, 5 years, we believe that it's the right thing to push harder now and expand the opportunity that we have in front of us to bring more benefits in the long term, which in turn will push back the value to our shareholders. So we're looking at maximizing this potential. And from a sort of numbers perspective, as a minimum, we're looking at 2 years out, 3, 4, 5 years, minimum of 30 to 40% revenue growth to be sustained longer term into the future. Okay, so thanks for listening. Yeah, we could definitely run through some questions now. We've got plenty of time to do that.
Yeah, super. Thank you, James. Thank you, William. Now, if we could turn to the questions, we have a number of questions that were submitted ahead of the presentation. However, please do continue to submit your questions using the Q&A tab situated on the top right-hand corner of your screen. I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet company dashboard. Additionally, your feedback is important to the company, so immediately after the presentation has ended, you will be redirected for the opportunity to provide feedback. While you're submitting questions, let us first have a look at those submitted ahead of the event. Now, there's one actually which was ahead and one which we've had submitted since. So I'm actually just going to combine the two, if that's okay. Firstly, what plans does the company have to strengthen the management, both commercially and technically, to cope with all the new and diverse markets? And if you could combine that with the second question, which you did touch on actually, how do you see the company growing in terms of numbers of employees and regional offices?
Yeah, okay, I'll take that one. So in terms of the strength of management that we have, we've gone from 10 people to 75 in the last 4 years, roughly. We've been very strategic, very particular about the people that we've hired. We have had the same vision statement for most of that time. So we've always been working towards this global market leadership position. So as such, we've been tactically hiring the right people into our management team across that time, certainly for the last 3 to 4 years. I'd probably encourage you to go to our website and have a look at I think it's the Why Us and Our People section. Take a look at the management team that report into myself and William. You can look at their LinkedIn profiles and you'll see that you've got some serious breadth of experience, very relevant to our market as well. and also a lot of global experience in there as well. So I think we're pretty well set up, and we have made one or two additional management hires in the last 12 months plus. Now, we also in that time have strengthened our board. So we had a new chairman come into place within the last 18 months. And Simon's got significant international software experience. He's also US based, although he's a British citizen as well. So that's been beneficial for the business too, in terms of fulfilling these long-term ambitions that we've got. And some of you will be aware that in September just gone, we also formed the company's advisory committee. Now, we only have one member on the advisory committee at the moment, a lady by the name of Neera Jones, who was a senior executive at Barclaycard, Santander, but that brings a wealth of experience from a payments perspective as well. And we've been very open about the fact that we do intend to grow our advisory committee. We see it as a low-cost way for us to gain additional perspectives to myself and the board. So we're going to keep doing that in line with the sorts of aspirations that we've got. But people are totally critical to this business. It's William will always tell you it's the majority of his costs going out the P&L. It's people related. But as with everything, we're looking at continuous improvement, and whether that be developing existing people that we've got or hiring new skill sets and experience, we're always going to be looking at it. And that talent piece firmly sits with me, so it's something I'm personally quite passionate about. The other question related to the amount of people and timing, did it, Tom? Can you just remind me? That question.
How do you see the company growing in terms of numbers of employees and regional offices? You did touch on the employee number.
Yeah. Yes, the employee number over the next 2 years, it's something like 25 to 30 people. In terms of regional offices, we're very light on this anyway, so hence I didn't really mention it. But we have our head office in the UK is in Ipswich. We also have a small London office, which, like everybody, we downsized. That's just in a WeWork location. Our US head office is in Charlotte, North Carolina, which is also in a WeWork location, and we intend to leverage WeWork for probably 3 additional offices in those 3 territories. But you're talking, minimal spend to be able to do that. So we could set that up overnight if we wanted to. There was another question in around, how long would it take us to get the territory set up? Well, we can actually move very quickly. So we already have the company incorporated in Australia, and we have the ability to operate in mainland Europe under the UK, and also Canada under the US today. So it's really about the timing that's going to suit us operationally, rather than any other blockers that might prevent us from moving any quicker.
Great. Okay. Quick one here. Now you have funding and shareholder support. What do you see as your biggest risk in the second half of 2021?
Well, given what we're about to embark on, it'll be the timing of that and getting the momentum moving with that. That's probably the biggest risk based on this plan, is that we get everything moving quick enough. That would probably be the risk that I would consider the one that could be most impactful if we didn't respond to it in the way that we'd planned. But as I said, I think it's a minimal risk. We are dealing with a lot of other aspects of the business right now that I maybe would have answered or offered up as an answer to that question previously. So we're very strong on the customer success side, and we're strengthening that now. The partner piece, we're not particularly dependent on individual customers. So I'd say it's really making sure we take this next step up and we do it in time with what we've assumed in our plans. But as I say, I don't think there's too much in the way of us being able to do that.
Great. Okay. A couple for you, William. The first one, you've done well to this point. When do you now expect the first months of sustained cash generation? There was a touch on that in James's previous answer, but maybe you could just reiterate that point.
Yes. So we've clearly been on the cusp of cash break even through our business model currently. With the new expansion coming out, as James said, we're going to push the profit break even point out 12 to 18 months. However, with our business model and us invoicing in advance on licenses. It's normal that our cash generation will run circa 3 months ahead of that. So you're looking at a 9 to 15 months period before we hit cash break even under the new plan, if all goes to plan.
Great. Okay. And one, just in terms of the revenue patterns, is there a seasonality to sales by quarter? And if so, what drives that?
Well, if I just cover off the ACV point, so there's a bit of seasonality. I wouldn't, there's the US, the quarter that runs up to Christmas is naturally a busy one for technology in the US, but I think we have not experienced strong trends so much in that, certainly not across this financial year so far, but certainly in the past, there's probably more what you were going to say, William, is that we do have a smaller number of quite large customers. I mean, proportionate to our revenues, it's, they're not big numbers percentage wise now, but for some reason, we have tended to sign those between sort of November and February time. So those renewals do impact cash, and they do impact recurring revenues as well.
I was just going to add also that the pandemic has aided our business model over the last 12 months. People have realised that they need to be more cloud-based. That's benefiting our partners, especially in the CCaaS providers, and that has opened up other opportunities to us, which has taken some of the seasonality out over the last 12 months, because there's a constant demand for the products, which is good from our point of view.
Okay, maybe we can just ask this question, which I know is a hot topic for private investors in many scenarios, but you chose not to include private investors in the fundraise. Why were we excluded?
Check I'm on mute. Okay. I mean, look, since I took over in the role of CEO, it's been a particular strategy of ours to increase the amount of information sharing with our private shareholders. We've really tried to step that up. That's why we use platforms like IMC to do that, so that we can be clear about our objectives and our goals, and it's not just institutional investors that get to have that access. We considered the whole open offer topic as part of the considerations we made around the strategy and the structure of the fundraise. Both, as a board, we did that with our advisors as well. But we made various considerations around it. We, at the time, wanted to move quickly. That we wanted to capitalize on the positive sentiment in the market at the time, and adding an open offer adds a layer of complexity, which means it adds time as well. It also adds cost too. So the cost could be north of £75,000 to go through that process. When gauging what the demand might be versus the cost, we had to weigh that up in amongst everything else. So if there had been a delay, for instance, as a result of doing the open offer, then we were very sensitive at the time to the screen price, and we knew that with the raise that we went through, that we needed to get as close to that screen price as possible, if not that screen price. We had something that we were aiming for, because we didn't want the price to erode the value of those existing holders. So all these things kind of combined, and we did ensure that the price wasn't heavily discounted. It was less than 10%, and we're in a really good position now to capitalize on the long-term opportunity that we've got, which we think will really deliver value to our shareholders, all shareholders, and all of those shareholders who have also benefited from the improvements and the execution that we've made over the last year. So we'll always consider all these options, and we'll discuss these things at length as a board, and we'll make the decision based on what we think will work long term in terms of returns for shareholders. But we feel that we made the right decision at this time, and we did review it. I can tell you we reviewed it extensively, and not just once either.
Yeah, great. Okay, well, thanks, James. A couple more that have just come in. You have a number of public sector customers. Can you explain why this is, and can we expect this trend to continue?
So there's that was a specific strategy in the UK. We started on that path quite some time ago. We knew it would be a slow burn. We particularly went out to win potential partners that would help us secure business in the public sector. We see public sector as a fairly reliable revenue source long term if we can get in, be well established. So we do sell direct into it. We have some large central government agencies that we've sold direct to, but we have a lot of customers through our partners Civica and Capita that we've built up over time. Now we have been proactive in the US as well, I might add. So we did announce at the half year that we'd signed one of the largest IT service providers to government, Fed and SLED in the US in the period. And we also signed our first US state, who actually went live 2 or 3 months ago. So we now have a state live in the US. Now it's very slow burn, but we do hope to use some of what we've learned in the UK to explore more in the US. So yeah, I'd say expect this trend to continue. We've got 45, 50 local authorities in the UK. I believe there's several hundred, so there's plenty more for us to go at. And certainly we see the value in government in other territories that we operate in. But all I will warn is they are slow. And in every area of them, selling to them, delivering their projects, all of those things.
Great. Okay. Just a quick one on the committee. Can you talk about how the development of the company in terms of its products, customers, and routes to market might change with the establishment of the advisory committee and the appointment of Neera Jones?
Okay, so we're not planning any major changes anytime soon, but what we are making sure of is that given the investment we've made into our technology, into this business, into our positioning that we are now in, we sit at this intersection between business communications providers, organizations and consumers, that we're keen to look for opportunity and add value to what we do. So we're ensuring that as a business that historically has been more expert, I suppose, in security and communications, that given we touch several other areas, so payments being one of those, we're making sure that we've got some advisory expertise that can perhaps give us another angle on things. So we're exploring all angles all the time as to how we strategically can deliver value and give ourselves more opportunities in the future. But we're not going to forget our knitting, no way. But we'll do that very carefully and cautiously. But it was pretty clear when we announced the advisory committee that we were raising our eyes to look, perhaps just outside our core. But we're not planning any major changes anytime soon, but as a minimum, it allows us to understand our own relevance to our space from the perspective of the payments market in having Neera on board. But as I say, we do expect to add more to the advisory committee in the coming 2 years.
Great. Super. All right. Well, look, last question before we close out, which might be a short one. Would you consider listing in the US at the right point in time?
That's not something that we're considering at the moment, but as we stated in our fundraise, we do have investors from North America now, hence we're doing this at 5 o'clock UK time. That's to try to cater for some other time zones that we know are following us right now. So it's not something being considered right now, but to say we do have interest in that region. So we're naturally having conversations with existing investors, just as we do with our investors in the UK.
Great. Okay. Super. Well, that's a nice close. Thank you both. Can I ask investors not to close this session, as you will now be automatically redirected for the opportunity to provide your feedback. If you access this meeting from our website, the feedback page will appear. If you access from the link sent to you by email, you will be asked to log in to submit your feedback. If anyone has any further questions or would like additional information on PCI Pal, please do get in contact via PCIPAL@walbrookpr.com. Alternatively, many thanks for attending today's presentation. We will update you again soon.
Yeah, thank you. Thanks, everyone.
Thank you, everybody.